Welcome to Morphic Labs, and today we are going to be discussing beyond sharp what quants actually care about, and we're going to be continuing our discussion from where we left off. In the last video, we discussed correlation in the covariance matrix. Today, we are going to be discussing chapter 4, maximum drawdown and risk of ruin. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. I will greatly appreciate it. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. If that sounds like you, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics. Plus, if you're interested in looking at markets in different ways and having a bird's eye view of markets in general, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven and hybrid methods, plus implementation and selection criteria. If you find that interesting, the links are in the description. You just gotta sign up to be a free member, and you have both of these resources all to yourself for free. Now let's get into it. Chapter 4, Maximum Drawdown and Risk of Ruin. Quants study the distribution of worst-case paths, not just the distribution of returns. An investor does not experience volatility as an abstract statistical measure. They experience it as a sequence of losses, eroding capital. Maximum drawdown and risk of ruin are two metrics that capture this experiential reality. Definition 4.1, maximum drawdown. Let V of t denote the portfolio value at time t. The drawdown d of t at time t is defined as d of t equals v of t difference max of v of s, where 0 is less than or equal than s and s is less than or equal than t, over max of v of s, where 0 is less than or equal than s and s is less than or equal than t. The maximum drawdown, MDD, over the interval, more specifically the closed interval from 0 to t, is defined as MDD equals the minimum of d of t, where 0 is less than or equal than t and t is less than or equal than t, or capital T, equals the minimum of v of t difference max of v of s, where 0 is less than or equal than s and s is less than or equal than t, over max of v of s, where 0 is less than or equal than s and s is less than or equal than t, which is all less than or equal than 0. The maximum drawdown measures the largest peak to trough decline in portfolio value. It is a path-dependent statistic, meaning it cannot be computed from the return distribution alone. The temporal ordering of returns matters profoundly. Now, here's where it gets important. Pay attention now. Two strategies with identical mean returns and standard deviations can have radically different maximum drawdowns. I must say that again because it's very important. Two strategies with identical mean returns and standard deviations can have radically different maximum drawdowns. The relationship between return and drawdowns is non-linear. A drawdown of D requires a subsequent return of D over 1 over D to recover. A 20% drawdown requires a 25% gain to break even. A 50% drawdown requires a 100% gain, and a 70% drawdown requires a 233% gain. Below, there's a formula for you to calculate how much you would need to recover in order to be back on your feet, which is defined as R sub recovery equals the absolute value of the maximum drawdown over 1 difference the absolute value of the maximum drawdown. 4.1, the calmar ratio. Now, this is a very interesting ratio. Most of you have probably not heard of it because most of finance is obsessed with the Sharpe ratio, which is useless. You haven't really checked it out. I have a video titled "The Sharpe Ratio is Useless." But yeah, this is a far more interesting calmar ratio. It isn't really that well talked about in the finance community or the quant space even. I hear a lot of quants just yapping on about their Sharpe ratio, but I've never heard a single quant, or at least maybe one out of thousands, actually talk about the calmar ratio. But I'm yapping on. Let me just get back to it. The calmar ratio, introduced by Terry W. Young in 1991, directly addresses the Sharpe ratio's failure to capture worst-case drawdown experience. Definition 4.2, calmar ratio. Let CAGR denote the compound annual growth rate and MDD, absolute value of MDD, the absolute value of maximum drawdown. The calmar ratio C is defined as C equals CAGR over the absolute value of MDD. The calmar ratio answers the question, how many units of annual return does this strategy generate per unit of worst case drawdown suffered? A calmar ratio greater than 1 indicates that annual returns exceed the maximum historical drawdown. A ratio below 0.5 suggests that the drawdown paying significantly exceeds the annual compensation. Let me read that again, because it's very important. Pay attention. The calmar ratio answers the question, how many units of annual return does this strategy generate per unit of worst case drawdown suffered? A calmar ratio greater than 1 indicates the annual returns exceed the maximum historical drawdown. A ratio below 0.5 suggests that the drawdown pain significantly exceeds the annual compensation, right? And essentially, this is where a lot of people get confused. Here's the thing. Your strategy can have positive EV. It can have the best Sharpe ratio on the planet. But if your calmar ratio is less than 0.5, you are losing, and you will lose. Guaranteed. Okay? The compound annual growth rate itself is defined as CAGR equals V of t over V of 0 to 1 over t difference 1, where V of 0 is the initial portfolio value, V of t is the final value, and t is the number of years. Unlike the arithmetic mean return, CAGR accounts for compounding and is path dependent. Here's a table that cross compares and gives us a little statistical insight. Table 2, calmar ratio interpretation 36-month look back. Over here we have the calmar ratio column, we have the rating column, we have the implications column. Now as you can see, a calmar ratio that's greater than or equal to 2, its rating is exceptional and its implications are returns significantly compensate for drawdown risk. Now, if your calmar ratio is less than or equal than 1, but it's less than 2, the rating is still strong and its implications are annual return exceeds or matches max drawdown. 0.5 is less than or equal than C and C is less than 1 implies that the rating is acceptable and the implication is reasonable risk-adjusted performance. Now, if your calmar ratio is less than 0.5, the rating is weak, and the implication is limited compensation for drawdown risk. And if your calmar ratio is less than 0, this rating is unacceptable, and the implications are negative return over measurement period, right? And that's a statistical insight about the calmar ratio. Very impressive function, I would say. It's doing far better work than the Sharpe ratio, at least. It's far more impressive than the Sharpe ratio, at least. To me, it's more impressive than the Sharpe ratio. Because it does something the Sharpe ratio doesn't, right? It actually measures risk, not just upside volatility, actual risk, right? 4.2, risk of ruin. Risk of ruin is the probability that a trader exhausts their capital before reaching a profit target. Unlike maximum drawdown, which is a historical measure, risk of ruin is a forward-looking probabilistic statement about survival. Definition 4.3, risk of ruin. Let A be the per trade edge and N the number of risk units in the account, where N equals total capital over risk per trade. The risk of ruin, or ROR, is defined as ROR equals 1 difference A over 1 plus A to the N. The derivation of this formula comes from gambler's ruin theory. Consider a random walk with absorbing barrier at 0, which is ruin, and reflecting or absorbing barrier at the profit target. The probability of hitting the ruin barrier before the target is given by the ratio of growth rates raised to the power of the initial capital in risk units. The edge A is computed as A equals W times W capi R difference L times L capi R, where W capi R and L capi R are the average win and loss expressed as multiples of the risk unit R. Critical edge case: if A is less than or equal to 0, the ratio 1 over A difference 1 plus A is greater than or equal to 1, and R of R tends to 1, 100% ruin probability, regardless of position sizing. No amount of risk management can rescue a strategy with 0 or negative edge. This is the mathematical statement of a fundamental truth. Risk management preserves capital. Only edge generates returns. Table 3 for some statistical insights. Here we have a risk per trade column, when we have N or risk units column, and we have a risk of ruin column. As you can see, if you risk 1% per trade, your N is 100, right? And your risk of ruin is approximately 1.9 times 10 to the negative 8, which is negligible. If you risk 2% and the risk unit is 50, risk of ruin is 1.4 times 10 to the negative 4. If you risk 5% with risk unit of 20, risk of ruin is 1.8%. If you risk 10% per trade and your risk unit is 10, and your risk of ruin is going to be approximately 13.5%. If you risk 20% per trade and your risk unit is 5, your risk of ruin is approximately 40%, right? Assuming an edge of 0.10. The table illustrates a counterintuitive but mathematically rigorous result. A fixed edge risk of ruin is extraordinarily sensitive to position size. Cutting risk per trade from 10% to 1% reduces probability by a factor of approximately 700,000. From 1 in 7 to 1 in 50 million. This is why professional quants treat position sizing as the primary risk control, far more important than entry or exit timing. I'm going to read that again. My timer disturbed me a little bit, but the table illustrates a counterintuitive but mathematically rigorous result. For a fixed edge, risk of ruin is extraordinarily sensitive to position size. Cutting risk per trade from 10% to 1% reduces ruin probability by a factor of approximately 700,000. From 1 in 7 to 1 in 50 million. This is why professional quants treat position sizing as the primary risk control, far more important than entry or exit timing. For prop traders with a drawdown limit, for example, 10% maximum allowable loss, N must be calculated using the drawdown ceiling, not the full account balance. A trader risking 1% per trade with a 10% drawdown limit has only N equals 10 risk units, not N equals 100, shifting the effective risk of ruin to approximately 13.5%. And that's about it for today's discussion. In the next video, I'm going to be discussing better quant approved metrics for measuring your risk. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be. If that sounds like you, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics. And if you're into the more nerdier stuff and want to understand markets from different angles, I have a free advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow microstructure aggregation, event-driven hybrid methods, plus implementation and selection criteria. If you find that interesting, the links are in the description. You just gotta sign up to be a free member and you have both of them all to yourself. And if you're interested in more content like this, hit the subscribe button. Don't hesitate. I would greatly appreciate it. And I'm out. Bye.